Hi folks, Deepak Shanai from Capital Mind here, welcoming you to Short Takes, our quick 5 minute summaries of things that we did or things that are interesting. StratOptions is our topic for today. We're going to save a straddle. We were short a straddle and we went inverted as part of our StratOptions strategies for a 3.5% return. So, now what is StratOptions? Capital Mind Premium has a strategy going that talks about using volatility metrics to get into options trades, different kinds, whether they're put spreads, call spreads, ratio spreads, or straddles and strangles, in order to benefit from either too low or too high volatility. We've done pretty well in the last 2 months. It's only been 2 months now, but this month has been severely volatile. So we try to take advantage of this volatility, but got fairly badly hit in the middle and then rescued the trade. And let's see how and what happened. So a couple of days ago, this was about on the 11th, on the 9th of February is when we started looking at the trade. So if you look at this area around here, we are talking about 7,300 was the area where the Nifty was. The VIX itself at the same time around the 9th, so that's about here, was starting to inch up towards 22. We usually take advantage of near term volatility. 22 was about the highest we had seen in the near term in the recent past. So we decided, well, it's time to go short a straddle. We took the 7,300 straddle. Now, blue line is the 7,300 straddle. It's the call plus the put premium available on snap charts at Capital Mind. What the snap charts shows you is the left hand side. The axis here is where we're showing the values of the straddle, and it was about 455 when we took it. So we waited. On the 10th there was nothing happening, the stock didn't move too much. So on the 10th the straddle actually went a little bit lower, even though the Nifty fell from 7,300 to 7,250 levels. The next day, that's the 11th, we saw a big move on Thursday. This was Thursday. The stock market started going down and further down, and suddenly at the middle of the day we were talking about a profitable position despite this kind of volatility. We were talking about a position that was at about 430 or 440. Suddenly the Nifty dipped quite a bit, and then implied volatility shot up. You saw the straddle start to lose money. Remember, we're short at 455. The straddle's gone off to 535, and we're at a VIX level of 26. This is a severely loss-making position. So we're gonna have to figure out what to do here. Now, still, it's not that bad. Now you're at Nifty 7,000. That was approximately where we were at. We had to make a decision. So what we decided to was take protection. We bought the 7,000 put. We bought the 7,000 put. We waited a little bit longer, and the 7,000 put over the next day gave us protection for another nearly 100 points, but the put was bought at 100. We managed to make only about 56 points because we traded in and out of it twice. So we got a 56 point protection. Now the strategy was at 6,900. Now remember, we've written the 7,300 call. We've received a 455 premium. So you would say 7,300 minus 455, that's 6,845. That's our break even, and that's much lower than the bottom part of this graph here. So it's about here. We were afraid, yes, that the Nifty would go there. So at 6,900, we decided to take a call and say, let's change our strategy. Let's write off the protection, and at this point we will switch over the calls. So we have a 7,300 put and a call short. The put is almost like a future at this point. There's no point taking it out. It's going to be extremely expensive. But the call has fallen substantially. So let's take out the 7,300 call, instead move to the 7,000 call short. So we're going to buy back the 7,300 call and sell the 7,000 call instead. This is called an inverted strangle because you are now short 7,000 call, short the 7,300 put. This effectively gives you a little more cover, and we'll do the math a little bit later. But what happened at that point was we did it at this point. Now we were at an inverted strangle, 7,300 call, 7,300 put, 7,000 call, And the way we can see that on this very chart is to just add this as a symbol. So we say Nifty, again we were going to March, so 16 March is 2016 March. We're going to do the 7,300 call and the 7,300 put and the 7,000 call, I'm sorry. So that's a strangle now. So we're going to plot this on this chart. What happens at this point is that, well, it comes in as a bar, so I'm going to just make this a line, and I'm going to change the colors so you can recognize it better. Maybe a little bit darker there. Yes, here you go. The 7,000, so here you have it, 7,300 and 7,000. Okay, I think I have the numbers wrong a little bit over here. Okay, they're actually not on the left axis, so you can't see them very well. Okay, so let me just move this to the left axis so that you can probably see them better. Yeah, here you go. So we're now here. So at this point we've actually written something here, and that option, what actually happened, let's ignore the actual values on this side, is that we bought back the 7,300 call at 80 rupees and wrote the 7,000 call at 190 rupees. So we got 110 rupees more in premium. So we add that to the 455 we received. So we were now at 565. We already had a 56 point booking from the protection. So that added to 621. So effectively our new strangle price was 621. And the position was actually around 660. So we were losing 40 points. But remember, the Nifty's fallen from 7,300 down to 6,900. That's 400 points, and all we're losing in this whole position is 40 points. That's substantial for a strategy that should be eternally loss making or has unlimited losses. But we were losing only 40 when the Nifty fell 400. Luckily Nifty recovered from this point, and from here we wrote it about at this point. From here the strategy recovered substantially, and we chose to exit around at this point, which is about 575, so 574 actually, and we made effectively a 47 point profit. And let's do the math on that. We can see it over here. We sold the 7,900 March straddle at 455. We bought protection at 100. We sold the protection at a 56 point profit. We also at that point covered the 7,300 call at 80. That means we bought it back, and we sold a new 7,000 call at 190. So effectively we got 110 rupees. We made a 56 point profit on the protective put, so we've added more premium of 110 plus 56. So now the total collected premium adds up to 621. We exited at 574. We made a profit of 47 points. Single lot of Nifty would give you 3,500 rupees of profit, which is about 100,000 rupees allocation per lot. The margin's only 80,000, but we would prefer to keep it at 100,000 at least, because things can move a little bit higher. You might actually need more margin at some point, so we roughly allocate about 100,000 per lot. So the profit is about 3.5% per lot. So if you looked at what we were doing here, essentially it's a strategy that involves targeting a certain range. So we were 3 to 5%. At 3.5% with this kind of volatility, it's best to get out. So that's a good way to protect the straddle. It's not the only way, but one of the ways to protect it is if you believe that you want a little more buffer on the downside, then you kind of move this. Now remember that we could have stayed without doing anything and the Nifty bounced substantially. We would have still made about 50 or 60 points on the bounce if we had held the original straddle. So if you look here, for instance, this ended up at 400. Remember we wrote it at 455. So at 400 we are at a substantially lower number to buy back at. So 55 points would have added up a little bit more than 47 that we actually booked. So we would have made about 3.7 or 3.8%. But it wasn't obvious that the Nifty was going to bounce from here. So if it didn't bounce, our strategy gave us a little more protection, further protection. Remember, it gave us 621 points. So instead of breaking even at 6850, it would have gone from 7,300 minus 621, which was which would have been substantially lower than 6,700. So that gave us another 150 points of protection, and we would do this over and over again, or choose to get out of the trade at a much smaller loss using this kind of a strategy. I hope you enjoyed this. This was StratOptions for you. We'll be back with a lot more. Do ask us questions. Tell us what